China retaliates with 34% tariff on US goods. Are we facing a full-scale trade war? China has just announced a massive 34% tariff on all US goods. A bold and direct retaliation to sweeping US trade tariffs launched earlier this month. This is not just a diplomatic disagreement. This is a trade standoff. The world's two largest economies are now locked in a high-stakes economic conflict, and the financial ripple effects are already being felt around the globe. Investors are rattled. Markets are shaking. And the big question now is, are we headed into a full-blown trade war? Let's unpack what's happening and what it could mean for your money, your investments, and the global economy. Earlier this month, the US government implemented a 10% blanket tariff on all imported goods. But that wasn't all. It also introduced targeted tariffs, with China facing the steepest increase of them all, a 34% hike. China's response: fast, direct, firm, and fierce. They've announced matching tariffs, a full 34%, on a broad range of US products. We're talking agricultural goods like soybeans and corn. We're talking industrial equipment, tech components, and high-value consumer electronics. This move is strategic. It's targeted, and it's intended to apply maximum pressure, especially on industries located in politically sensitive regions. And just like that, global markets are reacting. Stock indexes in the United States, Europe, and Asia have tumbled. The Dow Jones fell by over 600 points. The S&P 500 and the Nasdaq both dropped sharply as investor fears grew. Gold, the classic safe haven, surged past $3,100 an ounce. Agricultural stocks fell. Tech giants lost billions in value. And many investors began pulling money out of export-heavy sectors and shifting it toward domestic and defensive plays. So why is this such a big deal? Because this isn't just a policy shift. It's a signal. It tells the world that we're now entering an era where tariffs, not trade deals, may become the new normal. It tells investors that volatility, not stability, could define the next phase of the global economy. And it tells businesses that supply chains built over decades may now need to be restructured, and fast. Let's talk about who gets hit the hardest by these tariffs. First, US farmers. China's tariffs directly target American agricultural exports. And with soybeans, pork, and grains on the list, many family-run farms are facing the real possibility of reduced exports, lower prices, and tighter margins. Second, the tech sector. Companies that build or sell devices in China or source components from Chinese factories are facing a double threat: increased costs and reduced demand. Third, manufacturers, particularly those that export machinery or equipment to Chinese markets. They now face price barriers that make their products less competitive abroad. And finally, the consumer. Let's be real. Tariffs act like taxes. Businesses often pass the added costs down to shoppers. So you can expect higher prices on imported electronics, household goods, and even cars. But it doesn't stop there. Currency markets are also reacting. The US dollar has weakened on fears of retaliation and uncertainty. The Chinese yuan is under pressure, and analysts are warning that this kind of volatility could affect global trade for months, even years, to come. So what's the long-term risk here? One word: escalation. If the US responds to China's move with more tariffs, and China retaliates again, we could end up in a prolonged multi-year trade war that affects everything from employment to inflation to the stock market. Now you might be wondering, what can I do as an investor? How do I protect my money in this kind of environment? Well, Here are a few strategies smart investors are using right now. Number 1. Shift to domestic-focused companies. These are businesses that sell primarily in the US, with minimal reliance on foreign suppliers or customers. Number 2. Look at defensive sectors. Think utilities, healthcare, and consumer staples. These industries tend to perform better when economic uncertainty rises. Number 3. Consider gold, short-term treasuries, and other safe haven assets. When markets get rocky, capital usually flows into security. Number 4. Stay diversified. Don't put all your money into one sector or region. A balanced portfolio can help smooth out volatility. And finally, keep cash on hand. Having dry powder lets you buy opportunities when prices dip. Now, is there any hope for de-escalation? Possibly. Some analysts believe that back-channel talks could still happen. That both the US and China may use these announcements as negotiation tactics rather than firm, long-term policy. But others argue that this time is different. That this is the new normal. That we're watching the unraveling of decades of globalization in real time. The truth is, we don't know how far this will go. But what we do know is this. Tariffs have real consequences. They reshape markets. They impact jobs. They influence how we invest, how we trade, and how we save. So whether you're a trader, an investor, a business owner, or just someone trying to make sense of it all, this moment matters. This is more than just policy. It's history unfolding. And we'll be here to break it all down, every step of the way. Before we wrap up, here's a quick recap. China has imposed a 34% tariff on all US goods. Markets have dropped sharply in response. Gold has surged. The dollar has dipped. Sectors like agriculture, tech, and manufacturing are under pressure. And investors are rotating into tariff-proof assets to hedge the risk. So now we ask you, what do you think? Are we on the edge of a full-scale trade war? Or is this just a short-term power move? Drop your thoughts in the comments. And if you found this video helpful, hit like, subscribe, and turn on notifications so you don't miss the next major market move. Stay smart, stay protected, and stay financially aware.